go through some problems from chapter 13. The first one we're going to go through is problem 1. I couldn't get to cut and paste off of the website very well, so I'm just going to have to deal with what I have. So, excuse me, on February 2nd, the corporation purchased goods from Martin Company for $70,000, subject to a cash discount terms of $210 net 30. Purchases and accounts payable recorded by the corporation at net amounts after cash discount, so that means they record them net of the discount. The invoice was paid on February 26th. So, let's scroll back here a second. Alright, so we purchase goods, so I need to debit purchases, or if you're doing, notice they're using the periodic inventory system. If you did the perpetual inventory system, it would be inventory. Periodic, it's purchases. But it's subject to a cash discount of $210 net 30. So since I record them net, the other method is gross. This method is the net method, which means net of the discount. So it's $70,000, so I recorded at net of the 2% discount. So in other words, I record 98% of it. So 70,000 times 98% is 68,600, and accounts payable. If this was the gross method, it would be 70,000, 70,000. Then I paid for it on February 26th. February 26th was well after the 10 days, so I lost the discount. So the first thing I need to do is get the discount off my books, record the cash I paid, which is 70,000, and then I record purchases discount loss. So again, the steps: get the accounts payable off your books, record the cash, and I have purchase discounts lost. If I recorded this the gross method, these two would have been 70,000, so the entry would have just been get the accounts payable off your books, which would have been 70,000, credit cash for 70,000. The next one is pretty straightforward. April 1st, bought a truck for 50,000, so I debit truck for 50,000. Paying 4,000 in cash, so cash is credited for 4,000, and signing a 12% note for the balance, so I have 46,000. On May 1st, the corporation borrowed $83,000 from Chicago National Bank by signing a $92,000 zero interest-bearing note due from 1 year from May 1st. So notice we borrowed $83,000 by signing a $92,000 note. If we were back in, I think it was chapter 6, where you dealt with present value, I would probably figure out the present value of $92,000 for 1 year at whatever the prevailing interest rate was 83,000. Or I could go use my present value tables and determine the interest rate. So notice, basically, notes really can't be zero interest bearing. There's interest buried in that. So what I do is I record the notes payable. The notes payable is always at face. So notice it's a 92,000 interest bearing note, zero interest bearing note. So that is always the face amount. I got cash of 83,000, so I must have a discount on notes payable of 9,000, which is simply the difference. On August 1st, the board of directors declared a cash dividend payable on September 10th to stockholders of record on August 31st. On the date of declaration is when they become a liability, so I'm going to credit dividends payable and debit retained earnings. You could also debit dividends. And then when I paid them on September 10th to stockholders of record on August 31st, this is the date of record. All they do is accumulate the names to whom they're going to pay it to. So it's on September 10th I actually pay it, so I get rid of dividends and payable. Now I'm going to no adjusting entries. Let me read that. Okay. So those are the journal entries, and now they want the adjusting entries. So the first entry was the purchases and accounts payable. There's no adjusting entry needed. Quite frankly, if this was December 1st, and then I made an adjusting entry on December 31st, I would need to debit purchase discounts lost and credit accounts payable for $1,400 to get it up to the $70,000 that I owe them. So that would get the purchase discounts lost in the correct year. So if this was December 1st, and then I needed an adjusting entry on December 31st, ever I hadn't yet paid it, I would debit purchase discounts lost, credit accounts payable. But for this case, since it was in February, I don't have any adjusting entry. The next one, the adjusting entry of the truck is principal, which is always the face of the note, times rate, which is 12%, times time, so it's from April 1st, so April through December, if you count them off, that's 9/12. Sometimes you can just say it's everything but January, February, and March, but so principal times rate times time is 4140, so I have interest expense, interest payable. On the next one, I have a discount on notes payable of $9,000, so this is a 1-year note. So if I count from May to December, that's 8 months, so I have 8/12 of that done, so I take it to interest expense and take it out of discount. And then the last one, since they paid it by September 10th, there's no adjusting entry at the end of the year. Okay, now we're moving on to problem 3. This is a payroll. So assume we have the pays its office employees weekly. Both below is a partial list of employees and their payroll data for August. Because August is their vacation period, vacation pay is also listed. All right, so assume the federal income tax withheld is 10% of wages, union dues are 2% of wages, vacation are taken in the second and third weeks of August for Robbins, Kirk, and Sprouse. The state unemployment tax is 2.5%, federal is 0.8%, and both on a $7,000 maximum. The FICA rate is 765. An employer maximum of $118,000 per employee. In addition, 1.545 rate is charged to both employer and employee for wages in excess of $118,500. So first of all, it looks like we're pretty safe on the $118,500. Nobody is going to go over $118,500. If they did, you would simply not have, let's say they were $118,100, okay? Nope, $118,400. So if this guy had $118,400, I would only compute the other 100 for 0.0765 and 1.45 on all of it. Okay, so whenever do payroll entries, what is probably easiest to do is do a gross pay to net pay computation. So notice this is the weekly pay. This is what I've earned before, which may hit the 7,000. So it looks like Ken Sprouse is going to hit the 7,000. So is Alex Guinness. Isn't going to be subject to that, but we'll come back to that later. I'll do the gross pay to net pay computation. So I just added these up, and they add up to 1,040. And then it says federal income tax withheld is 10% of wages. So this is simply 10% of wages, so I'm withholding that. I also have FICA at 765, and nobody's above 118,500, so FICA is just 0.0765 times that number. And union dues are 2% of wages, so I simply take 2% of the 1,040. Okay, the state unemployment tax rate is 2.5% and federal is 0.8%. However, unemployment taxes are not withheld from employees' pay, they're only paid by the employer. And the FICA rate is 765 on employer, and so that is paid by both employer and employee. So I can also do the employer. I'll pause this just a second. All right, so now we're going to do the employer portion of it. So the employer pays 3 taxes: FICA, state unemployment, and federal unemployment. FICA is simply you match the employee, so I just brought that number down there. State unemployment is paid at the rate of, where is this? 2.5%, but it's of the amount over 7,000, and 0.8% of the amount over 7,000. So notice they haven't earned over 7,000 yet. They haven't earned over 7,000 yet. They haven't earned over 7,000 yet. But these two have, so none of theirs is subject to unemployment. So my unemployment taxes are simply paid on $460 of wages. So in this one I have $460 times 0.025. So I have $11.50, and then with this one is 460 times 0.008, since it's 0.8%, so you need to take it times 0.008. So there's my employer taxes, and so notice they add up to $94.74. So I hope you write that down, because when I make the entry, basically what I do is I debit the expense for this one, for the 1040, and I'm going to credit payables for all of those. So Fed tax payable, FICA tax payable, union payable, and this one will be salaries payable. So when you get to that, again, hopefully you'll write it down. And then I have all of these are payroll taxes expense. So I'm going to debit payroll tax expense for the total of $94.74 and credit where they're going. So FICA payable, state unemployment payable, federal unemployment payable. Okay, so I put these side by side so we can see salaries and wages expense of $1040, and I credit payables to where the money is going to. So it's going to Fed withholding payable, FICA taxes payable, union payable, and I usually say this is salaries payable. They did cash in this journal entry. The payroll tax expense is $94.74, and then I credit where it's going to. So payables for FICA, federal unemployment, state unemployment. Okay, the next one is this one. So notice it's entries for payroll 2 and 3. So these are the first week in August and the second week in August. And notice you kind of have to read this carefully. Vacations are taken in the second and third week of August. So this is their total vacation, and we are taking them over 2 payroll periods. So you notice when we get down here, we'll divide it by 2. And this is the same entry for payroll 2 and 3. So the next thing that we need to do is figure out these people aren't going to get their weekly pay. They're going to get their vacation pay. So I only have this person and this person getting their weekly pay. So the first thing I do is add up these three, 300, 220, and 660, divided by 2 because they're taking 2 weeks of vacation. So that's salaries and wages payable for 590. Because now I'm taking something that had previously been earned. Then I debit salaries and wages expense for the 2 people left who aren't taking vacation. And notice the taxes are basically the same. Okay, so kind of what's happening is they're getting their regular pay. So notice 300 is twice that, 220 is twice that, 660 is twice that. So they're getting vacation pay that they have already accrued in a previous period. And they're getting that for 2 weeks. And then the payroll tax expense is exactly the same. And then payroll period 4 returns to exactly the same as payroll period number 1. And then what happens when they actually write the checks for it, they write the checks once a month. So I get rid of all the payables and credit cash. So that's really not too hard. Kind of the hardest thing sometimes is separating out when you read it. Okay, on this one I'm kind of going to talk about some of the journal entries as I read it. So we sell television sets for an average price of $900. Remember that. So my sales revenue is $900 right over here. And it also offers each customer a separate, this is separate, that's kind of important, 3-year warranty contract for $90. So I have $90 over there. That requires the company to perform periodic services and replace defective parts. During 2017, the company sold 300 televisions and 270 warranty contracts. So my sales revenue is 300 times 900 because I sold 300 of the TVs, but only 200 of the warranty. And under the warranty, you cannot earn it until time has passed when you incur the warranty cost. And so let's see, if 3-year warranty contract. So I'm going to earn 1 year at a time for 3 years. Okay, so I'm going to record the journal entries for 2017 where I just debit cash, credit sales revenue, and credit unearned warranty because on the day of sale, time hasn't passed. So in a year, I'll earn a third of that. What liability relative to these transactions would appear on the balance sheet and how would it be classified? So I have my unearned warranty revenue. So remember, it's 3 years, so 1 year is current, 2 years is non-current. So I've just split that between, divided by 3 is 8,100, so 1 year current, 2 years non-current. Okay, and remember that we said that we earn 1/3 of it every year, so that's all I'm doing here is I'm taking it out of unearned revenue and putting it into revenue. And then in 2018, the company incurred actual costs relative to the television warranty sales of $2,000 for parts and $4,000 for labor. And so basically now I incur the costs of the warranty, so the 2,000 parts comes out of inventory, and the salaries and wages is $4,000. I put it into warranty expense. If you gave them their money back, you'd credit cash. So you credit whatever in the heck you give them, and in this case it was parts, and I had to pay a repairman to do it, and it's a warranty expense. Okay, so notice that if I have a perfect guesstimate of that, my revenue would exactly offset my expense for the period, and notice it doesn't. For D, what amounts relative to the 2017 warranties would appear on the balance sheet? So again, it's $8,100 a year, and I only have 2 years left, so 8,100 current, 8,100 non-current. Okay, premiums are not exactly difficult. They're just sometimes complicated because you just simply have to read it and do what it says, and there's got lots of things going on sometimes, so it's easy to get lost. So to stimulate the sales of its Aladdin breakfast cereal, I wonder if they have Jasmine also, Lopatin Company places 1 coupon. So remember that, 1 coupon per box. So I would write that down there, 1 coupon per box. Then it takes 5 coupons are redeemable for a premium consisting of a children's hand puppet. So there's 1 coupon in a box and 5 coupons needed for each puppet. So in other words, 5 boxes. In 2018, the company purchased 40,000 puppets at $150 each. So I'm going to stop right there. So what we did is we got an inventory of premiums. You can call it an inventory of puppets if you wish, and cash. So we're going to use these to redeem. So 40,000 pups at $1.50 each. And sells 480,000 boxes of Aladdin at $3.75 a box. So I debit cash and credit sales revenue for 480,000 at $3.75. Okay, so that's just those transactions. Now I have to estimate how much I'm going to have collected under there. So from its experience with other similar premium offers, the company estimates that 40% of the coupons issued, so remember it's 1 per box at 480,000 boxes, okay, and only 40% of those will be issued, will be mailed back for redemption during 2018. So here's where it gets complicated. So 40% of the $480,000 boxes will be redeemed. Here we go. 480,000 times 40% is 192,000. Okay, but remember, it takes 5 coupons to get a puppet. So later on down here, you'll see we'll divide it by 5. So first here's our estimate there. Okay, During 2018, 115,000 coupons are presented for redemption. So we're a little bit off on our redemption estimate. We thought, I guess it could take longer than a year. So we've got 77,000 outstanding. So remember, we bought our puppets at $1.50 each, 40,000. So we put it in inventory of premiums. Again, please feel free to call it inventory of puppets. I recorded the sales of my cereal, which would be recorded that way whether they had coupons or not. And now I have redemption of 115,000 coupons, but remember it takes 5 each. So I have 115,000 divided by 5, and each of these puppets cost $1.50, so I have premium expense and inventory premium. So instead of cost of goods sold, I'm moving it over to premium expense, all of the puppets I mailed out. So think of it this way. How many puppets did you mail out? Well, 115,000 divided by 5 is how many puppets I mailed out. And each puppet costs $1.50, so I need to get that out of inventory of premiums and into premium expense. Then the next one that I need to do is estimate how much premium liability I have for December 31st, how much I have left. And so again, I have my 480,000. I think there's 192,000 going to be sent in. So far, 115,000 has been sent in. So I have 77,000 left outstanding. So remember, in the matching principle, all of this has to happen in 2017. I need the premium expense, in essence, for 192,000 redemptions divided by 5 in premium expense, times $1.50, I should have said. Okay, 115,000 is turned in, and this is yet to be turned in. So this is 77,000 divided by 5 times $1.50 is $23,100. So again, the matching principle says I need the premium expense in the same year I have the sale. Okay, some people would have just done premium expense for the whole thing and then premium liability for the whole estimate, and then when people cash them in, debit the premium liability and credit inventory premiums. So I think that's it.